Most people think that cash is safe. Cash is the least safe investment. It just doesn't have the same volatility to it, but it has, because they're producing so much cash, it has a negative real return.
The Federal Reserve is stuck between a rock and a hard place. With out-of-control inflation caused by unprecedented money printing, it looks as if they will be forced to raise rates, which has both the stock market and crypto market spooked. With the market falling day after day, many investors are choosing to flee to cash as a safe haven asset to invest in. In this video, Ray Dalio, one of the greatest money managers of all time and amongst the best performing hedge fund managers ever, explains why cash is in fact the least safe investment and its value is on the brink of collapse. Make sure to stick around to the end of the video where Dalio reveals that he has actually been buying up both Bitcoin and Ethereum as alternative assets to cash despite his skepticism in previous years. Also, only a small percentage of my viewers are actually subscribed. If you enjoy finance content, consider subscribing or liking the video. It's free and you can always change your mind.
You know, in 1945, we began a new world order. 1944, we created a new monetary system, the Bretton Woods monetary system. And then we created that new world order. And that created a bull markets in stocks and an American world order for the most part. There's a cycle that we're used to, in which whenever you have an economic downturn, the central bank hits the gas and can create debt expansion, and that produces an increase in demand. And that happens in three phases at the cycle. Normally, it's interest rates. You lower interest rates and the economy turns up. But when you hit zero interest rates, which happened in 1932, debt crisis, 1932, we hit zero interest rates. Then you go to the second type of monetary policy in which central banks print money and buy financial assets to add liquidity. And those purchases, those sellers of bonds who get the cash, go out and they buy other financial assets, and we have the process going through. And that's the second type of monetary policy. So the only two times that happened was 2008 to 9, 1929 to 1932, zero interest rates, print money, monetization. That'll carry you so far. And then there's what I call monetary policy 3, which means that that money does not trickle down to the population and go all the places that it's needed to go. And that monetary policy means that there has to be the what we're seeing now in monetary policy. In other words, the coordination between fiscal and monetary policy so that the central bank is buying assets of a different sort, a wide range of assets, producing liquidity, and also having the effect of buying government debt and monetizing it. And that's the late cycle of an expansion. That's what's driving the markets now. That's what's driving the economy now. For example, today, the Federal Reserve and the government is creating the liquidity that we're seeing in the markets. And it has big implications for the value of money. What is the value of money? Where does money go? Cash is going to be a poor investment, and so it goes elsewhere. So that's the character of the environment, which means that if you look at the returns of asset classes and you take cash, isn't it an interesting world when you have zero or negative interest rates? And then there's the desire to create a spread in that, so the short-term rates are lower than long-term rates. And when there's so much liquidity, it is the central bank that is making that market. So when we look at the market today, it needs the storehold of wealth, and you see it reflected in all asset classes. So that's the main driver. And it also has very big geopolitical implications, because as we come into this environment where we have the second influence, the wealth gap, the political gap, it means that the distinction of how money and the bills are going to be divided and how that will affect tax policy and the like will matter a lot. I think it's very much like the 1930s, which means when there's, it doesn't produce immediately a general level of inflation. It negates deflationary pressures. And what it does is it produces currency depreciations over a period of time. In the 1930s, all currencies in the early 30s depreciated in relationship at that time in relationship to gold. And so what we see is the same kind of thing happening without a general level of inflation, but not just gold. It goes into other storeholds of wealth, and stocks is an important, particularly certain types of stocks it goes into. And very much the same as 1933. In 1933, March of 1933, Franklin Roosevelt severed the connection with gold, printed money, and made money available. And that was the exact bottom in the stock market. Very similar to April 9th when the Federal Reserve and the Treasury did the same thing. So that goes into other assets such as stocks and so on, and creates a reflation. It is necessary to be done because the consequences of not doing it are unacceptable. The wealth gap and so on, you referred to that. We're in a situation where every individual, every company, every government has a certain amount of revenue, a certain amount of expenses, and a certain balance sheet. And when the revenue goes down and to be low or inadequate relative to the expenses, and there's not an adequate balance sheet, then defaults and restructurings take place. That's true for the population as a whole, and that's true for a number of businesses, hence the policies that we're seeing. What has been true in history is that when you have an economic downturn, that's a serious economic downturn, and less effective monetary policies at that same time, and you have a large wealth and values gap and political gaps, you tend to have fighting, internal conflict. And so rising internal conflict about how to divide the wealth pie is very, very normal historically. And so that's the dynamic, I think, that we're now seeing that will become manifest in changes in tax policy and so on. The investment environment going forward will be very different from the environment of the past. I mean, think about it as a zero and very low returning asset environment, because the liquidity that's in the market is driving the excess returns of all markets down to be low in relationship to the very low cash rate. So negative real returns, not good for cash and so on. The most important thing is to know how to diversify well. And what I mean by that is to go beyond just the traditional 60-40 stock bond mix, or even the same countries, and to broaden that diversification. To include in that portfolio assets that might seem unusual, to include some gold, to include inflation index bonds, to think about the currency exposure, to think about safety as different. Most people think that cash is safe. Cash is the least safe investment. It just doesn't have the same volatility to it, but it has, because they're producing so much cash, it has a negative real return. It's a tax that maybe 2% a year you lose money in terms of cash. So you have to think about risk differently, and you have to diversify best. That's the most important thing, to have a well-diversified portfolio. The uncertainties that we have today are so great in terms of all the things I mentioned, the tax policies, the geopolitical. Certainly we must experience it with the virus. Will the next wave come back, and how will it be there? Diversification can be achieved without reducing your expected returns because of the way that asset classes are priced. And then if you're going to take tactical bets from those, then those tactical bets, alpha on top of that strategic, well-diversified portfolio, should have highly diversified bets deviated. Liquidity is going to be more important than before because things change in unexpected ways. Look at how, in many of the cases, the businesses that one would have thought was a good business, and let's say you're in private equity, and that you're with that company. And so the restructuring, the ability to rebalance and diversify and to be cautious about making a highly diversified set of bets is, I think, the future. But thinking even of asset classes, thinking about the value of money. You know, we look at asset classes and we say, oh, do I want my money to be in stocks and which stocks? But we don't think about stocks, bonds. We think about those traditional asset classes, but we don't think about the value of money and what's going to happen in terms of the printing of that value of the money and how to diversify it well. So I think those are the things that have to be paid attention to in much as they were important things in years prior to 1945.
Well, I'm not going to give the precise amount of Bitcoin, but I do own some Ethereum as well. But the answer to your question is that I don't own a lot of it. I view it as an alternative money in an environment where the value of cash, money, is depreciating in real terms. And I think it's very impressive that for last 10, 11 years, that programming has still held up. It hasn't been hacked and so on, and it has an adoption rate. So I'm very big on diversification, and it's a relatively small part of the portfolio. I would like to say that cash, I've been quoted, cash is trash, that cash, which most investors think is the safest investment, is, I think, the worst investment, and that it's important because it loses buying power. The one thing I would say to investors is don't judge anything in your returns or your assets in nominal terms, in terms of how many dollars you have. View it in terms of inflation-adjusted dollars. And so cash, like this year, you'll lose 4 or 5% to inflation. And so pay attention to those, because I believe that that'll be the worst investment. And then beyond that, the important thing is to diversify one's portfolio well, because we know from that the surprises in the balance. We also know that those asset classes on average significantly outperform and will significantly outperform cash, and that they move between each other in a way that that has to do with correlations, because of when things go down, when the economy goes down, then bonds will do better than stocks, and so on and so forth. So diversification of assets. I view crypto as a small piece of that, and the message is cash is going to be a problematic asset, and hold that other diversified portfolio of assets. Keep looking at it in real terms, not nominal terms, and that diversification should be also international diversification from countries, not just asset classes, in order to have a truly well-diversified portfolio.